You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everyone. Annuities have gotten a bad rap for a long, long time, primarily because there's a large sector in the market, primarily fiduciaries like us, to be frank, who have publicly ripped them apart for all the reasons they've deserved to be scolded, if I'm being honest. But are annuities bad investments? My answer is yes and no, and I'm going to tell you why they suck and then share some situations where maybe there might be a place for them in an investment portfolio within the right situations. But first, as always, a few housekeeping items. If this is your first time listening or watching, then thanks for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often and feel free to subscribe on iTunes and YouTube. If you're more of a listener, check us out on iTunes. You can listen to us in the car, on the treadmill, on your walks. And then on YouTube, if you're more of a watcher or you just don't use iTunes all that much or podcasts, YouTube is the way to go. But by subscribing, what that means is you'll get alerted as soon as these get recorded. So for instance, I just started recording this at 1:37 p.m. on Thursday, but we won't send out the emails letting everybody know that they've been published until tomorrow, Friday. Sometimes we even wait into the weekend or after the weekend. So if you want them right away, feel free to subscribe, excuse me, and you'll get the alerts right away. In addition, you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and other educational resources are always available on our website. We've got a plethora of educational resources from past articles, screencasts, podcasts, and so on. Today we aren't going to have any visuals, but we're going to be talking a lot about annuities, why they suck, and situations where they might make sense after all. So let's go ahead and get started here. I always like to start with a quote, and the quote today is, "Beware of the truth. You may have gotten a hold of the wrong half." And I think that's applicable in this situation. I'm guilty, and I will admit it, of beating up annuities, maybe unrightfully, writing articles, creating videos in the past, call it 10 years ago or so, where I really beat the crap out of annuities because, and it's not so much because the products aren't good. It's the issue with me has more to do with how they're sold to people, and I use that word sell intentionally. I think they are sometimes oversold. I think they are sometimes missold to the wrong people. I think they are another way that they're oversold is not only to too many people, but with too much of their money is invested into an annuity. So what I want to do is I want to go through first and foremost, why is it that they aren't so good? You know, what's wrong with annuities? And the first reason why annuities aren't so great is because of, like I said earlier, a few strong opinions. So those opinions can kind of seep through the market landscape. They can seep through articles online, places like The Motley Fool, places like Fisher Investments, I know, has echoed a lot of the things that I've said in the past about annuities not being so great. But to draw a hard line and say annuities, or any investment for that matter, is a bad investment, don't touch it, I think that it takes a little bit more research, thinking, and evaluation to see if maybe that's really the case or not. So since we're over the fact that, you know, some strong opinions are one reason why people think annuities suck, let's talk about the real reasons. The first real reason is most annuities have very high commissions and internal fees. Now let's break that apart into both. So the commissions, what usually happens in, call it 90% of the, I'm just making this number up, I'll say 90%, because 90% of the industry or more are non-fiduciary brokerage firms, advisory firms that are fee-based, not fee-only fiduciaries, and they have the ability to earn a commission. There's also insurance agents who can sell annuities and earn a commission. So in those situations, these commissions can be 4% of the invested amount. They can be 7%. I've seen them as high as 10% in the past. So, you know, if you put, say, $500,000, say $500,000 into an annuity, then there's a chance that the person who sold it to you can get 7% of that investment, or $35,000 right up front, and it doesn't come out of your investment. You won't see it, but they're getting paid that $35,000 up front, and that's how high these commissions can be. The internal fees, there's something called mortality and expense ratios. There's a cost for basically tax deferral, which these days I don't think most people even use annuities for tax deferral, which is what they were originally designed for, call it 3-4 decades ago. Most people are buying annuities for all the enhanced death benefits, income benefits, withdrawal benefits, which we're going to talk about today. So there's internal fees inside of annuities that make them more expensive. And again, just like the commissions, you won't see those fees either. You have to look at the prospectus or your policy and really dig into the fine print in order to find out how much they're costing you. But just to use an average or a rule of thumb, if you're looking at annuities and you're looking for ones with guaranteed income benefits or withdrawal benefits, and especially if you're looking at ones that have death benefits as well, enhanced death benefits, you can expect that the internal annual cost of an annuity is going to be around 4% and sometimes higher. So that's 4% per year, by the way, not once. Yes, and then the commissions that exist, obviously there's a penalty that exists to recoup that commission that's been paid, because if the insurance company or annuity company pays the financial advisor a commission up front, and then you decide you want to sell it a year later, they have to recoup what they paid the financial advisor, and they do that by charging you a penalty to get out. So at our firm, because we're a fiduciary, we have access to the same annuities that commission advisors, or call it fee-based advisors, have, but ours just don't have commissions and they don't have penalties, and they're less expensive internally than a brokerage annuity, we'll call it. So if I say that a little bit simpler, there are about 25 companies in Central Ohio, in our case, because we're in Columbus, Ohio, that are fiduciaries, fee-only fiduciaries, and we legally cannot charge commissions. And so as a result, it doesn't cost you anything to get into the annuity, it doesn't cost you anything to get out of it. So if you own it for a year and you don't like it, at 6 months, 2 years, and you don't like it, we just get out. This is opposed to the many other firms that are out there. Call it, well, I don't want to pick on any company names, I guess, so I'll leave it out. But just think of all the big names that you've heard of, all the big names that you see on TV, the commercials. Typically, those are fee-based firms. They're not true fiduciaries in that they can charge commissions. So because you can't see those commissions, and because they're paid directly to the financial advisor, what ends up happening is you have kind of a conflict of interest that exists. So if a financial advisor has the ability to earn a commission on an annuity, and they're given a choice between putting your portfolio or investing your retirement money into something that is going to pay them, say, a 1 to 2% annual fee, so nothing up front, but just a 1 to 2% annual fee, and then putting it into something that pays them, say, 7% up front. It doesn't even have to be somebody who's new or struggling, because that's what's one of the things I've heard. It's like, well, I just have to be careful. I'm not working with a financial advisor who's new and might need the money more than somebody who's older. I think that's valid. That's a valid concern. However, even financial advisors who are older and who've been in the business a long time might want to renovate their kitchen or their bathroom, or they want to put an addition on their house, or they want to buy a new car, or who knows, whatever the expenses that they have, there might be a conflict of interest that exists where they go, man, if I put this individual or couple or business owner's portfolio into something that just pays me a smaller fee annually versus something that's going to pay me 7% up front, I might not be able to put the deck on the back of my house like my wife wants me to, or my husband wants me to. I might not be able to surprise my husband with that car that I've been really wanting to get him for his birthday this year. So if I just put him in this annuity instead of putting the client in the smaller annual fee portfolio, what we call a wrap account, I might get $35,000 up front, and that pays for my bathroom remodel, let's just say. So that's the conflict of interest that exists. Probably the biggest one. I mean, there's more, but that's the biggest one. So these are the biggest reasons why annuities, when you see articles, when you read research that says annuities suck, These are the reasons why. Again, number one, they have really high commissions. Number two, very high internal fees. Number three, you can't see the commissions or internal fees unless you read the prospectus or the policy. Number four, the commissions are paid directly to the financial advisor by the insurance company or annuity company. You don't pay those commissions, and then there are penalties that exist to sell them, and you pay those penalties in order to recoup those commissions that are paid. Unless, the only caveat is, unless you're buying an annuity through a fiduciary fee-only financial advisory firm, registered investment advisory firm, like our firm, for instance. There are others in Central Ohio. There's others around the country that work just like we do. So there is no conflict of interest when you don't have the ability to charge a commission. You don't have a conflict of interest to offer one type of portfolio over another investment product because you get paid essentially the same. So, moving on. The problem, and this is something that I say at least once a week in our office. The problem with annuities is that so many who invest in them think, and when I say so many who invest in them, I mean the advisors, financial advisors, the professionals. But the problem with annuities is that so many who invest in them think that they're the best investments for all clients for all of your money. And the truth is, annuities can be great investments, but only for some people, and typically only for some of your money, not all of your money. And so let's talk about when annuities might make sense. So some examples. So number one, annuities, and I'm talking about variable annuities specifically here, by the way. I'll mention a few of the other types of annuities in a second, but let's focus on variable annuities. First of all, when again, we're talking about when do they make sense? An annuity, a variable annuity with an income benefit, guaranteed minimum income benefit, guaranteed minimum withdrawal benefit, but we'll just speak to the income benefits. Variable annuities can offer a guaranteed, we'll call it a pension, so to speak, that'll last for the rest of your life, regardless of what happens in the stock market or what happens in your portfolio. And that's a good thing. They can also fill what we call expense gaps that exist in cash flow and retirement. So I'm going to show you an example here in a second. But that's another good thing. So one, they offer a guaranteed pension, and two, they can fill expense gaps, gaps in our fixed expenses, the things we need to survive. Number three, they can help anxious investors, people who hate the stock market, hate real estate. They just don't like the market. They don't understand it. It freaks them out. They're very conservative. It can help these anxious investors get exposure to inflation protection. The last 3 decades, we've had inflation in this country of, call it 2 to 3%. We're finally starting to see inflation pick up here, and I don't know that it's a God-given right to see inflation in the United States at 2 to 3% per year for the next 10, 20 years. So inflation gets higher. It's going to be a whole lot more difficult to put money in risk-free, meaning guaranteed investments that cannot ever lose money, and keep up with inflation. That's going to become very, very difficult. So number three, a variable annuity with an income benefit can help anxious investors, people who don't like the stock market, get exposure to that inflation protection without a cap above your head. So in other words, you can participate in the stock market when you need it through the use of that guaranteed minimum income benefit, let's just say, which reduces stress when confronted with the inevitable short-term volatility of the stock market. So if you need income and you also need inflation protection, in other words, you need your money to grow over time, then the variable annuities can help you get that inflation protection to a certain extent, at least get some growth in your assets over time. And if you don't need any income, so this is the number 4, if you don't need income, if you say, my pension that I already have, my Social Security, my spouse's Social Security, we have plenty. We don't need any more income. Well, you might be somebody who's still very conservative, or maybe you know someone, maybe it's a parent who's very conservative, who refuses to put their money into the market, into the stock market, even though they never, ever plan on spending the money. So picture this person who maybe they're 60, 70 years of age. They've saved very well. They have a nice nest egg, and they make plenty of money, so they aren't going to use a big, huge chunk of their money, and they have it sitting in savings, checking, CDs, money markets, or something, whatever. Think of very, very low interest-bearing vehicles. An annuity, a variable annuity, there are some out there that have enhanced death benefits where you put the money into the annuity. it grows in a portfolio that's invested in stocks and bonds, which initially I know that sounds scary, but it would have, say, let's just, for example, it might have an annual step up where you would if the person or individual who owns the annuity were to pass away, then they would get the kids or the beneficiaries would get the higher of the maximum anniversary value, what they invested, or say a 5% bump each year, whichever is higher. So if they invested $500,000 and it grew to $600,000, but then it fell to $400,000, then let's just say if the anniversary value was $600 and it was locked in, then if that person passed away when it was worth $400,000, then the beneficiaries would end up getting $600,000, not $400,000. So think of it like the high water mark. And speaking of high water marks, here's an example of how an income benefit might work. This one, just for full disclosure, because I did kind of just run a screenshot here, and I don't want to get in trouble without any disclosures, but this is the Lincoln Annuities I for Life growth benefit, as well as their I for Life income benefit. So what we're looking at here is the shaded area, and I'm sorry if you're listening on iTunes, we're looking at a mountain chart, basically a shaded area that represents the portfolio of investments. And then there's a stair step that goes up, where if the portfolio or the stock market and the portfolio go up higher than 5%, then the anniversary value of that investment is locked in at a high water mark. If the following year, let's just say the market were to go down or the portfolio goes down and it does not exceed 5% simple interest, then it steps up 5% on the previous anniversary value. If that happens every single year for a while and the portfolio or the market never catches up, then you keep getting 5% simple interest until the market does catch up. And let's just say 6 years has gone by and all of a sudden the market catches up and now you get to snap in or lock in your anniversary value because the growth was higher than 5% that year. And let's just say this keeps going on for 10 years or so, and all of a sudden you say, you know what? I'm done working, I'm retiring, I'd like to turn on the faucet and I'd like to start receiving income, guaranteed income from this investment. The way it would work in this case is you would get 4.75% of the maximum anniversary value for the rest of your life, even if the portfolio were to go to zero. You would continue getting that monthly income. If it's on 2 lives, so if it's a joint life, then it would be a smaller percentage, 4.25%, but that faucet again continues on then for 2 spouses or 2 lives over the course of time. If you're somebody who's already retired and you're thinking, you know what, I don't have the time, whether it be 5 years or 10 years, to let my investment grow, I need guaranteed income right now. Well, what we could do is we could take a portion of the money, a portion of your money, I should say, invest it into an investment like this one, or this one exactly, doesn't make a difference. And we want to use obviously whatever makes the most sense, and then we could turn on the faucet immediately. So we could say, I want to invest $400,000 because I need $20,000 per year of guaranteed income for the rest of my life. And you could invest, let's just say $400,000 as an example, and get that guaranteed income for the rest of your life, starting right now without having to wait 10 years, let's just say. So that's kind of how these things work when we talk about guaranteed minimum income benefits. Now let me share a quick example of, again, where these might make a lot of sense. First, let's just say you have a $25,000 per year Social Security income. And I'm mixing this up a little bit here because I'm trying to hit a bunch of people at once. So let's just try to cover all demographics. So we've got one person who's getting $25,000 per year from Social Security. We've got another spouse that's getting $35,000 per year from a private pension from their employer where they used to work. Maybe STRS, State Teachers Retirement System, Public Employees Retirement System, SERS, or any other public, let's just say, pension program. So basically, they have $60,000 of total income. But after analyzing their fixed expenses, and when I say fixed expenses, we're talking if there's a mortgage, that would be part of fixed expenses, home insurance, property tax, utilities, grocery bill, all these things that you need to survive are all part of your fixed expenses. And let's just say the total fixed expenses are $80,000. I'm just going to use $80,000 as an example, which means if our income from Social Security and pension is $60,000, but our expenses are $80,000, and we have a big portfolio, we'll just say I have $1 million portfolio, and right now we're just kind of taking $20,000 out per year. Some people might have no problem with that. They might say, you know what, I got $1 million. I'm going to take $20,000 out per year. Not worried about it. Doesn't bother me a bit. And in that case, an annuity just doesn't make sense for you. If you're comfortable with the market, the stock market, if you're comfortable with volatility, if the ups and downs in the market, the market goes down 5%. Roughly 5%, 3 times per year on average. The market goes down between 10 and 15% every year on average. And then, of course, there's the big flash crashes. There's bear markets and market crashes. So if none of that stuff bothers you, because you're of the thinking that long term I'm gonna be okay, then an annuity just doesn't make sense for you, and you're better just to keep the lower cost portfolio of of diversified strategies, and to just take systematic withdrawals from your portfolio. You would need an annuity. But if you're somebody who does worry about the market, does worry about volatility, if running out of money concerns you greatly, if the news, watching financial news or just local news, listening to the radio and hearing things about the stock market, if that freaks you out, if that bothers you, then an annuity might make sense, or at least it would make sense for you to get educated about how it might work in your situation to see if it might reduce your stress. Because that's really, in my opinion, what these things do, is it helps to reduce your stress so then the rest of your portfolio can grow for inflation and growth and vacations and fun stuff. So in this example, let me go one more time through it. $25,000 a year from Social Security, $35,000 a year from a pension. That means we're making $60,000 a year gross. This is obviously before taxes. We're not going to talk about tax though. $80,000 in fixed expenses. 80,000 minus 60,000 obviously is $20,000 shortfall, or gap as we call it. Let's just say we were to throw $400,000 of our $1 million portfolio into an annuity with a guaranteed minimum income benefit. What it might do is provide us with $20,000 per year of guaranteed annual income. And now what we've done is we've filled that expense gap. So now we've got, let's just say out of a $1 million portfolio, we've got $600,000 now that's growing for us, maybe a little bit in a balanced portfolio, moderate growth portfolio, doesn't really matter, but that doesn't have the guarantees. It's a lower expense portfolio, and then that's our vacation fund, that's our fun money, that's buying cars, that's road trips, that's gifts. If we want to do special gifting for the kids or grandkids. So that's how this might work, and that's a hypothetical example of how an annuity might make sense. Now, a bit of caution. I know I've mentioned that word inflation several times here, and this is kind of like I mentioned my number one pet peeve when it comes to annuities over the years has been they're oversold and missold. I think the number one most overlooked problem when it comes to the details in annuities, and specifically guaranteed minimum income benefits within the annuities, is the lack of inflation protection. And over time, while the annuity will protect your income from falling, so that it'll be guaranteed, it won't go down, there is a high probability that the income will flatten out over time. So if you're getting a little bit of a raise each year, as long as the stock market's doing well, if we have a year, not if, but when we have a year where the market goes down for 1 or 2 years straight, a big bear market like 2007, 8, 9, 2000, 2001, 2002, we haven't seen a bear market like this since, for 13 years. So when this happens again, there's a good chance that whatever your income hit at the top of the market would probably stay at that amount for a very long time before any inflation protection would catch up by way of that portfolio catching back up again to where it was at the peak of the market. So the problem, the number one most overlooked problem, I think, when it comes to the GMIBs or guaranteed minimum income benefits, is that once we go through a market crash and the portfolio, the principal has gone down, while your income will remain flat, it will flatten out without any increases for quite a while, if not forever. So the reason why that's important is exactly why I said earlier, when people put all of their money into an annuity, it's just a big pet peeve of mine, because if all of a sudden now you're stuck with this income, let's just say your portfolio, your $400,000 portfolio went up to $500,000, and then the market crashes and it's worth $300,000, you're taking out almost 5% per year. The internal fees are 3.5% to 4% per year. So you have to make 8-9% just to break even. Never mind growing the portfolio back up from $300,000 to $500,000 again in order to start getting raises in your income. And by the way, maybe now's a great time to say to pause for a second and say, geez, isn't this stuff complicated? And the answer is yes, it's very complicated. In fact, we haven't even talked about equity indexed annuities, fixed indexed annuities, hybrid indexed annuities, fixed annuities. We haven't even talked about that because it would take another 20-30 minutes to go over those investments, and we're not going to talk about that today. But the point is that these things are complicated, and even listening to this podcast or watching this podcast today, hopefully you've learned some things about it, but really it takes a little bit more education and understanding whether or not this fits inside your retirement puzzle or not. And speaking of these other types of annuities, I did just want to run through them briefly. Again, beyond the scope of this podcast today, but one type of annuity that we did not discuss today is called a fixed annuity. Fixed annuities are super easy to understand as compared to what we've been talking about. Just think rate and a date. So a fixed annuity might be 5 years at 1.5% per year. So you can buy a fixed annuity, let's just say for 1.5% per year guaranteed for the next 5 years. You could buy maybe a 10-year fixed annuity where it's 2% per year guaranteed for the next 10 years. As you could probably imagine, that's not a very high rate, and it's a really, really long time. So the problem with fixed annuities right now is that rates are near historic lows, so the idea of locking in interest rates at such a low amount is not necessarily the most desirable right now. Another type of annuity is equity indexed annuities, and think equity. Remember, the word equity means stock or ownership, so they're tied to an equity index like the S&P 500. So equity indexed annuities, they can make money. They get a certain percentage of the upside in the S&P 500. Usually it's a percentage of up capture up to a cap or just a cap. And then there's fixed indexed annuities, which are tied to a fixed income index, like the Barclays Bond Index, which is, the AGG is the Barclays Bond Index. So this would be, you would get the return of the bond index up to a cap or a certain percentage of the up capture. Hybrid indexed annuities are just a combination of the equity and fixed index. So it could be tied to both the S&P 500. It could be tied to the bond index as well. It could also be tied to things like commodity indices, like gold or silver, for instance. And the bottom line when it comes to these indexed annuities, and this is all I'll say today, is that what you get in terms of rate of return over time, once you filter through all the complications, all the bells and whistles, and you've dotted all your I's and crossed all your T's, what you get is relatively low over time in terms of rate of return. So you cannot really expect to get much more than 3 to 3.5% per year over, say, a 10-year period, even though it might sound, or they might be sold in a way where, and this is, again, a pet peeve of mine, the way equity index annuities are sold is they'll say, well, you'll get the market, or if the market goes down, you don't lose any money. It's like, well, that's kind of true. Yes, you won't lose any money, but if the market goes up 30%, are you going to get 30%? Absolutely not. No way. So make sure you understand them. So they sound really good. But you want to make sure you don't go broke safely. And that's one of my favorite, one-liners over the years. Going broke safely is investing your money in a way that's entirely too conservative, and you don't keep up with inflation, and thus, over time, you can't keep your lifestyle. In other words, inflation outpaces your lifestyle, and over time, you end up spending down your money until there's nothing left. So there is a such thing as inflation risk, interest rate risk, and these risks are very real. And most of us, when we think of risk and investing, we only think of stocks in the stock market. But there's other risks that are very, very real, and just because it's guaranteed doesn't mean it's good. So we're just going to go ahead and quit there for today. I hope that you enjoyed today's show. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, if you own annuities and you'd like to get an assessment, free assessment, second opinion, we'd be happy to give you one. If you'd like a free second opinion on your entire financial plan, retirement plan, estate plan, we'd be happy to give you a review, a second opinion on that with no obligation whatsoever. And remember, you never ever have to be a client to ask a question. So if you'd like to set up an intro call, just a phone call over the phone to just chit chat and get to know each other, or a Zoom meeting, we can do either of those, either by giving us a call, shooting us an email at info@libertaswealth.com, or you can even go over to our website at libertaswealth.com to the contact page, and there's a link there where you can schedule something in our calendar and actually get access to our calendar. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today, so thank you so much for tuning in. Be sure, again, to subscribe on both iTunes and YouTube, and remember, you can sign up at libertaswealth.com to not only get these updates, but other screencast videos, articles, and things that we send delivered directly to your email inbox when they come out. Feel free to follow us on Facebook at facebook.com/LibertasWealth. Again, I'm also on Twitter at Adam Koch and Instagram at Financial Surgeon. So thank you so much once again for joining us, and we will see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.